This is James Berman using Trefis to model Paychex's intrinsic value in the context of rising rates. Paychex makes money on the float, the money it holds for clients temporarily before it sends them to the taxing authorities, and Paychex has been hurt by low interest rates and the low yield it receives on float. But as rates rise, Paychex is going to be able to invest that at higher rates, and we're going to look at the effect. Trefis is assuming that Paychex will only be able to get a 1.1% yield on its float for the next 7 years or so. I believe that short-term rates will rise. I believe they will rise substantially over the next several years. And if they do, then we can look at the effect on intrinsic value. You see, as I pull the rates up here, it causes a rise in the intrinsic value to the left. That's because Paychex makes more with every basis point rise in rates on the float. If you believe, as I do, that short-term rates are going to rise substantially, several hundred basis points over the next 7 years, to really just return to a normalized level of rates, then you can see that if we get up to close to 4%, Paychex's intrinsic value rises to $40. So Paychex is one of the few companies, along with other payroll processors and some insurance companies, that can make money on the back of a rising rate environment. Thanks for listening.